Sharing now. Why don't we get underway then?
All right, folks. Well, this is my name is Chris Murphy. I'm here with my partner, Chris Runcie, and a great panel of folks that he'll be introducing in a second. And we're DebtLink. We're glad you're here. Quick little bit about DebtLink. We are the first searchable, private, free directory hub, 24-hour day, 365 trade show. Fancy yellow pages, the first Yelp of our industry. We've been called a lot of things, but we're happy you're here. This is our second in a series of webinars called Voices of the ARM Industry. And today we'll be focusing on debt financing and the whole world there. And since I'm not an expert in that area, I'm going to hand it off to my partner who is, and he'll take that to talk to you a little bit more about the topic. I'll be monitoring questions and chat. So if anybody needs to post a question, you're welcome to do it. Anybody wants to, either use the chat or the question functionality, I'll be monitoring that during the webinar. And with that said, Mr. Runcie, you got the ball.
Appreciate it. Thank you, Chris. All right, folks, everybody, welcome. I want to give a special thanks to our gracious sponsor today, LexisNexis Risk Solutions. And I want to welcome three experts in the lending space, each of whom I've known for at least a decade, in some cases 2 decades. First off, Jeff Marin, Managing Partner at Sheridan Asset Management. Greg Paulo, Chief Revenue Officer at Flock Specialty Finance. And Todd Goff, Managing Director at Ironwood Funding. Thank you, each of us, for joining us. I want to kick things off by asking Jeff to tell us a little bit about himself and about Sheridan and how he got to be in the seat that he's in today.
Chris, thank you for the invitation and having us. We started Sheridan 23 years ago, recognizing there was an opportunity to provide financing for small to mid-sized finance companies and debt buyers across the specialty finance space. We have participated in secured assets such as small commercial mortgage, resi mortgages, C&I, and have been active in small business and consumer and litigation finance. And we try to do 3 things here. We lend to finance companies or debt buyers, we joint venture, or we buy performing or non-performing assets. I came to the conclusion to starting this after leaving a couple investment banks where we participated actually in the debt buying business as a financing source and did a securitization. And we've been doing this for 25 years. I think it's an interesting space and look forward to joining the panel members who are all, quality solutions in different ways for any of you debt buyers that are out there, and look forward to answering any questions that any of you have.
Perfect. Thank you, Jeff. All right, Greg, you're in the hot seat next.
Hey, thanks, Chris. I'm Greg Powell. I'm a Chief Revenue Officer at Flock Finance. I've been working over at Flock for about 9 years. We're a specialty finance company. We cater primarily to the middle and lower market of debt buyers, providing a joint venture solution. We also dabble in some other asset classes, medical liens, tax liens, some performing auto transactions. But our motto is that we're more than a transaction, and we're trying to help people manage their capital and grow their footprint in their respective areas of expertise. I came up through the credit bureau world, worked for TransUnion and Equifax for about 15 years. Worked with one of the larger collection agencies, RMA, which is now, I believe it's part of the NCO family, I think Radius now. And then owned and operated my own kind of small boutique collection agency called Redline Recovery Services out of Buffalo, Houston, and Atlanta.
Super. Thank you, Greg. And Todd, you're up next.
All right. Thanks a lot again for putting this all together. I founded Ironwood about 26 years ago now, and we mainly focus on lending to the purchase of non-asset-backed consumer revolving debt. Typical balance is sub $10,000. That's varied a little bit over time and in different environments. We'll gladly evaluate any opportunities that includes performing loans as well, but generally speaking, we're in the non-performing defaulted consumer non-asset-backed area. Two areas we do avoid, just to throw that out early, is non-elective medical. We're not somebody that has that area of expertise, and we tend to avoid military debt portfolios. Over the last 5 years, here recently, we've put to work about $150 million in loans, purchasing the face value of $3.5 billion. And to be clear, we're not a buyer. We are the financial partner to several debt buyers. So we are their lending partner, but we do get involved in underwriting, sharing our historical performance that we've had over 26 years in different types of portfolios, putting together performance curves. We consult on liquidation strategies, and we do provide business development in terms of issuer relationships that we've forged over the years and bring those to the table. So we really look to forge long-term relationships. Our goal is not doing business with a lot of debt buyers, but doing really, really solid business with a handful or a few debt buyers at one time.
Perfect. Perfect. Yeah, and that's a great lead in. So we're going to do a poll shortly of some of our attendees just to get a better feel for where they're at in the process. But, you know, in my experience as a broker for more than 20 years in this space, it's interesting. People will often reach out, obviously, for product and inventory. But the next question very frequently is about available financing. And a lot of new debt buyers in this space are surprised to learn that there are companies such as each of yours that specialize in lending in this arena. And that's really why we wanted to do this webinar today, to help educate folks. There are a tremendous number of opportunities out there in the market right now. I think more than probably most of us have seen, at least in the charge-off arena, for many, many years. And so we thought this would be a great time to talk about how third-party financing works, what's involved, what you need to have in place. I think we want to launch a quick poll of our attendees right now, just to give a better feel for our audience. So bear with me a moment while we do that.
So what we're going to be looking to do, we want to find out who's here. Are you first-time debt buyers, considering debt buyers, a veteran, that sort of thing? So when you see the poll pop up, click away, and that'll help us understand who's watching. And we can cater some of the comments to that population.
Yep. And I'm having some problems launching the poll. Bear with me just a moment. Karen, if you're there and can help, that would be great. All right, rather than delay, we'll continue to work on that. My apologies. I just I can't actually find the button to click on to launch the poll, so my bad. So if you're a debt buyer or you're interested in getting into debt buying, you know, there are a few sort of standard options that you have available. And what we want to show on this slide and what we want to talk about is some of the advantages of the specialty finance lender. Obviously, friends and family is a place that many people go first, but there are some significant limitations. If you have access to a high net worth individual, that's another option that many debt buyers will often explore. And it's possible, although less likely, that you have a bank or credit union relationship that would allow you to borrow. But what I really want to focus here on this slide is some of the benefits of a specialty finance company. And you see down the left-hand side here, we've listed some of the different features. And I want to focus in, at least on this slide, and talk about the value that a specialty finance company can add. And so I'd ask Jeff, maybe you to go first. Just talk a little bit about, touch on any of these features, but specifically, you obviously have a lot of experience here. You underwrite a lot of deals. You look at a lot of deals. Talk to us a little bit about how you can add value to a transaction for a borrower.
Well, thank you, Chris. I think, as the other panelists have great experience, we try to differentiate ourselves a little bit because we will this time around being active, we're not a debt buyer, but we could play at any part of the capital stack, from co-investing in equity to being a senior lender. And I think having the flexibility to provide different solutions for the community out there can provide value. But I think what's really critical from our perspective is, one, that the people we're doing business with look at regulatory and compliance matters, number one. And number two, people forget, can you report? Can you report accurately from a historical perspective and a current perspective, what your collections look like and what metrics that we might need? Having the ability to report is really important. It's quite honestly, that ties into having historical information or some reason for us to have confidence that we have an idea of how this certain type of debt will collect. And we will do everything from subprime to fintech to low balance to judgments, anywhere where there's value. So I think like my colleagues, I think they'll refer to reporting, static pool information, and compliance as things that are important. I think any of these guys and myself can also add value, especially to a newer company that we try to, and I know they try to provide sort of an institutional solution for the smaller debt buyer community. I think there's a lot of advantages that we all can do by giving you some rules of the road, having done this a little bit. So I think those are the things, experience from being in this space, and the sort of the good and the bad, and what we've seen be successful.
Yeah, no, that's great. That's great. Greg or Todd, anything to add to that?
I would just say that I typically ask the people, my partners that I'm working with, kind of, what are you trying to accomplish? Right. And so, there are two types of debt buyers out there. There's passive, and then there's, other folks that are active, that are actively collecting it. And obviously buying debt is kind of their business. And so are they looking to expand their footprint, grow their portfolio? Are they looking to feed their servicing network? It really depends on kind of what their objectives are. And so then different things become important to them. Advance rate, how much money do they have to put into each deal? And all three of us, Todd and Jeff and I, we look at these deals and we're assessing the risk. The more money that a debt buyer puts in, the less risk there is in that deal. And the other terms, such as interest rate or back-end share or servicing fees, become much more flexible. When it's a riskier deal where we're putting in more money, some of those features get a little bit tighter. So it really comes down to kind of what is your objective? Are you looking to feed your servicing platform and make your profit off the servicing platform, or are you trying to make money off the investment? You have to take into consideration whether you're using your money or whether you have other investors involved in the transaction. And I think one of the really big benefits of using a company like the three of us run is we'll walk you through each one of those stages of the things that you need to kind of evaluate, and the boxes that you need to check. And then hopefully you'll get a model at the end of that process that says, this is kind of what the deal looks like, and this is how we can structure it. The other thing is that, a real big challenge in this market today is the pricing of portfolios. All the sellers and the brokers, no disrespect to you, Chris, are obviously driven by, higher prices. Whereas, does the portfolio support that price? And I think the three companies here have historical liquidation data and things that'll tell you, hey, look, at this price, you're kind of riding the edge of the investment curve. You may want to create a little bit more room and pay a lower price, or hey, you can go a little bit higher in a bid environment to buy this portfolio and still make your return targets.
Yeah,
Well
no, that's a
said.
great point. A great point. Todd, anything to add?
Well, those are all great points. I agree with all of that. The only thing I would maybe add is the environment has changed like many businesses over the last 3, 5, 10, 15, 20 years to the point where, and you can see this in the publicly traded companies, they're underwriting to sometimes a 1.1 multiple just for cash flow purposes in their case, or sometimes I've seen them underwrite to negative multiples, again, for cash flow purposes. But because of pricing, like Greg had mentioned, and because of an increase in overhead costs due to labor costs in many places around the country, you've really got to be a partner to these debt buyers in eking out every single last penny out of an account to maximize the value output. So we have found more and more over the last several years that we've gotten more involved in just that, whether it's consulting to the liquidation process or something as simple as enlightening firms on how many hands touch a dollar. And every time a hand touches a dollar along the way, the risk increases. So you've really got to set up a lot of traps, if you will, and checks and balances to make sure that you're getting in everything you're supposed to get. Because there, in my experience recently, there are not many 4X portfolios out there for sale.
Yeah.
And there aren't many people collecting 4 times cost on a gross basis either. So you've really got to be careful with your spends, and you've got to be careful with your operations. And I think we're sort of the lasso around that, trying to keep our partners, corralled a little bit and not get wild on the buy side and taking too many risks.
Yep. No, that's a great point. Before we jump from this slide too, I think these are all important differentiators, but one of the other major ones, and this came up yesterday when we were all talking, rehearsing for the call today. I want to touch on guarantees or indemnities. And, in most arrangements, typical bank lending arrangements, there is an unlimited personal guarantee. And I guess I'd ask each of you to talk a little bit about what sort of guarantees you have in your structures, whether they're facilities or loan agreements with your borrowers.
Who do you want to go?
Jeff, you can go first. You got it.
Because we, like my colleagues here, aren't a bank, we don't charge like a bank. Our facilities don't require a personal guarantee, but they do require what we would call an indemnity guarantee, and for lack of a bad boy guarantee. And basically, there's things that you or your company can't do, or it would then become a personal guarantee. So, but we don't do any straight out personal guarantees. As long as people adhere to the rules of the road, we have to look at the collateral for the repayment mechanism for us to get paid back. And I think it's a better course for somebody to give up some rate to not have personal guarantee risk in their own personal life. So I don't know how my colleagues handle it, but we don't require personal guarantees, but we do have, like I said, what we would call an indemnity guarantee that just is one that makes sure people agree to behave accordingly. And as long as they do, we just have the collateral to look at as a form of repayment.
Got it. Perfect. Greg, how about you?
Very similar to what Jeff was saying. We don't require personal guarantees or corporate guarantees. We do have what we call as a bad boy guarantee, which is the same as Jeff's indemnity guarantee. As long as you are honestly remitting and reporting numbers and distributing the proceeds on a timely basis, we're pretty much riding along with the value of the asset that we're collateralized against. We do, it really depends on the deal itself. We have had clients come to us and ask for different structures, which might require a minimum payment or require a guarantee. We're able to do that. I'm sure Sheridan and Ironwood can do the same thing in the right situations. But kind of the advantage of using one of these specialty finance companies is not having that guarantee kind of tied around your neck. And if it's a big enough, like there's some larger transactions that could theoretically take a company down if it didn't perform.
Yeah, no, it's a huge differentiator. I think that's why this category is so popular in this debt buying space. Well, that's a main that in my mind, it's the guarantee and the value that you all add to a transaction that really differentiates you from some of these other groups.
It also speaks to our confidence in underwriting the asset. I mean, it's a great second opinion on the asset that you're pricing, and if we're willing to do that without a guarantee, we're both in the boat together.
Yeah, and we're gonna talk more about due diligence. You bring up another good point, because I want the audience here to have a better understanding of what's involved, what the expectations are, what information they need to provide, and then what you do on your side and the time that sometimes takes. Because I want people to be aware that this isn't, you don't call today to get a loan to close tomorrow. There's definitely some legwork that goes into these things in advance. Todd, before we jump to the next page, I want to just give you an opportunity to talk about the guarantees, if you'd like to comment or add anything additional.
Yeah, just real quick, we're the same. Non-recourse loans. It forced us many years ago to become pretty good, we think, at underwriting portfolios, because the portfolios are our collateral to the loan. We do file a UCC1 against the collateral, but no personal guarantees. Don't break the law. There won't be any problems. Same as everyone else.
Okay, that's great. Just responding to a question here. Okay, that's wonderful. All right, so now I want to sort of dig in further to some of the different borrower considerations. There's a bunch of different structures. There's a bunch of different ways to approach it. I know that there are some common themes, but I guess one of the first ones I was hoping to tackle today with this group was the difference between a dedicated facility and a portfolio specific loan. And Jeff, will go in the same order again. Do you lean toward one or the other, or do you do both?
I mean, we'll do both. We would definitely lean towards a credit facility, because as much diversification you can have as a lender, that's a good fact. But we will do a portfolio specific opportunity. And it's really based on how much data and performance history or batch track history do you have that can support what the curve you're projecting to be and where you're buying it at. So it's like anything else. We're going to confirm, as my colleagues do, what we think the curve is going to perform like. And if you're pricing it to 1.8 times gross, well, you know what? If you want a portfolio specific opportunity, we're going to require more equity. And, we're going to look at that portfolio tightly. If you're buying things to 2.5 to 3 times, then, we're doing the same activity, but there's more room for error, because what we have found, whether it's a forward flow or a portfolio opportunity, in a flow, you can have 12 monthly flows, even though it's homogeneous. It doesn't necessarily mean it's going to perform the same. So you really have to have a range of outcomes in these things to realistically, and make sure at the lower band of those outcomes, we're going to get our money back. And so, first loss capital, haircut capital, whatever you want to call it, your historical curve history, what the margin is in the opportunity, all those things go into portfolio specific financing or credit facility financing.
Greg, how about at Flock? Do you do? I know you do portfolio specific loans. Do you also do facilities?
Yeah, well, we can. So what our distinction is size. Credit facilities, typically we don't want to do anything under 20 to 25 million in a credit facility. So most of our clients typically do portfolio specific initially. The challenge with a credit facility is that you have to have a very, very good handle on your portfolio and an understanding of how a borrowing base works. And, which is essentially how much asset you have, an ER&C do you have in the portfolio versus what you owe.
Yeah.
And so you have to be very, very good at managing that and doing redraws if the portfolio outperforms or underperforms your historical curve. We prefer the portfolio specific because we're underwriting each portfolio with you as it comes up. We will commit to a flow, but every month that the flow comes out, we do compare that file to previous ones. We run a stratification. We check to see if the balance ranges are changing, if the state mixes are changing, if the age of the account is changing. Anything that might, first payment defaults, have they changed in the file? We have seen time and time again, clients sign up for forward flows only to find out at month 6, the file quality changed.
Yep.
And so we help them identify those file quality changes. And then we make an attempt to reprice the portfolio with the seller.
Perfect.
One thing I was just going to add to that, because those are great points. I think Greg and Todd will agree. One of the other areas that we can help is if you're not as experienced at negotiating a purchase and sale contract, making sure that all the appropriate things are in the purchase and sale contract that makes the seller adhere to what they're selling you is what they're selling you, whether it's media and when the media needs to be delivered, or the configuration of the underlying loans themselves, how much could be, some debt settlement or some other component. I think those are the types of things where, one could get some assistance, because we're in a partnership that, what needs to be in that purchase and sale agreement to make sure that you're protected.
Yeah, we see that all the time, especially if you're a newer buyer, right? With less experience, you haven't seen as many of those PSAs. You don't know what's customary, what's not customary. That's a great point. Todd, anything before we jump to the next couple of bullets?
It's interesting. I've never really thought of it this way. We've always done a credit facility.
Okay.
We spend so much time doing due diligence on a borrower. We have been able to streamline that somewhat over the last several years, but we're always trying to triangulate data within the industry of who people are, in addition to background checks and everything else. And it just feels like after we get through all that, a facility just makes sense. Now, it doesn't mean we won't do one-off deals. Within the facility, we'll do one-off deals because we're underwriting them and have ultimately the final say of yes or no, you can't buy that. It's not just a blank check. But we have looked at and evaluated deals too, and everything's priced to risk, right? So if somebody came to us and said, hey, I have a portfolio specific need, we'd certainly take a look at it. But generally, everything we've done has been within a facility of some sort. Whether they use it all or not, that remains to be seen.
So follow-on question then, Todd, to that point. If we've got, and I know we do have some folks on this call we have experienced debt buyers, but we definitely have a subset of debt buyers who have less experience. If someone's on that inexperienced end of the scale, maybe they don't have the static pool information on 100 different acquisitions. Is there a way how would you approach that? If there's a new debt buyer, they're looking to put a facility in place and to work with you, are there ways to overcome a lack of experience directly buying?
Chances are probably good that we have either direct experience with the portfolio or the pool, or have access to someone else that's willing to share that information with us, another industry partner. Additionally, we probably have a lot of crossover within their network. So, we can get comfortable in different ways, either knowing the debt, digging into the background of the debt, or like-kind debt even. You can find a lot where you've got similar underwriting standards, just as a different name effectively.
Okay.
So yeah, we can still get there.
You don't have to come to the table with 100, pick a number, 50, 100 purchases under your belt.
No.
Okay. Okay. How about Greg and Jeff? Curious to hear about loan sizes. So I understand that Todd sort of does more facility related lending. You each mentioned that you do more portfolio specific lending. I know you all have preferences, but what's a range of deal sizes that you would consider?
You know, Greg, do you want to take it or you want me to take it first?
Go ahead, Jeff.
You know, for us, you know, if it's on the smaller end, you know, sort of the 1 to 5 million end, we'd rather try to figure out a way to co-invest and be
Okay.
able to get, you know, help somebody diversify their capital stack to get the benefit of spending the time on 1 million to 5 million and getting, you know, sort of the better gross dollar return for us. But our lender finance facilities, you know, can be up to, you know, 25 to 50. But what we've tried to do is figure out where can we best differentiate ourselves, you know, in the market. And so I would say, you know, in the specific opportunities, a lot of them, and Greg can correct me, they're probably million to 5 million type opportunities. We'll do those, but we'd prefer to try to figure out how we can maximize more dollars of return by being a co-investor in some shape, way, or form.
And I want to be clear. So that 1 to 5, that's spend amount.
Yes.
Yeah, because we've got some state debt buyers on this call too, who I'm sure are seeing deals.
We'd go down to 2. Listen, if it was a state buyer that's experienced,
Yeah,
you know, if you know, we'd go down to 250 to 500 as an equity, or when I say an equity partner, it could be a very high LTV loan and upside, or it could be equity depending on the regulatory and compliance construct, because that's job number one. But
got it.
we would, you know, play in any of those areas.
Okay. How about you, Greg? Anything to add?
Yeah, well, yeah, we're just a little bit different. We view it a little bit differently. We want to look at what your anticipated annual spend is. We typically don't want to onboard anybody who's not going to have a spend of somewhere around $1 million a year. We view it as planting seeds for the future, helping some of these debt buyers grow. But we're doing deals on a regular basis at $100,000 a month in spend for the purchase of the portfolio. But those are typically people that, you know, that they're going to buy 6, or it's a part of a flow, you know, and so, you know, if you're going to spend $1 million a year, we're happy to talk to you. We know you can't guarantee it because things change, but once we do our due diligence and create our document set, all of our expenses have pretty much been you know, sunk into the relationship, and so doing add-on deals is typically not that difficult or expensive for us to do.
Okay, perfect. That's
I would agree with that.
I want to just remind all of our attendees that we do have the ability to, in real time, accept questions. There should be a button on your screen that allows you. So if we hit anything that you have a question on, or we're not touching on a specific subject or haven't hit upon it yet, feel free to enter in the question there, and we'll make sure to read it out loud and get a response.
Hey, Chris, can I add something on that?
Yes, of course.
We're very IRR driven, so we'll go pretty low in terms of a spend if it makes sense, you know, from an IRR standpoint. So like Greg, you know, we've done deals probably lower, you know, $50,000, but that's not what we're targeting or what we're after. Usually there's something bigger behind it, or it's an early bite to try to gain more flow. But again, even on those smaller deals, if we're talking about a 40, 50, 60 IRR, where we're going to get to a zero basis fast and get our risk off the table, we're really more driven by that than we are driven by size.
Awesome.
I would agree with that also.
I love it. All right. So we touched on loan sizes. How about, and I want to keep this moving, and I want to be mindful of time. We're about 40 minutes in already. It's amazing how quickly the time goes. Can we talk a little bit about typical advance rates? And there's lots of discussion about waterfalls and back-end participation. I'd love to have one of you sort of describe, and I know that there's no standard arrangement, but for our audience, some of them may not understand how a waterfall works, servicing fee, back-end participation. I'd ask one of you to take a stab at sort of describing a typical loan and how it's structured, if you could. Greg,
go
want to go
first.
first? Yeah, Todd, go for it if you're ready.
All right, yeah. We may be, from what I've seen, fairly unique in the industry. We'll advance up to 90%. Typically, we're looking for, much like Flock, in fact, I think Greg will touch on this, and everybody for that matter, we've got benchmarks set up along the way, performance-based. So we would like to see, and this is a typical deal, to use your term, we would like to see a zero cost basis at 28 months.
Perfect. Yep.
Ours is very different in that we're not charging P&I, principal and interest, along the way. Everything that comes back from a remit is split pari, and it goes towards principal repayment. Our interest then that we charge is accrued and accumulated and all pushed to the backside, which then falls into an interest bucket instead of being labeled participation. Not for any tax purposes, not for any other reason than avoiding passive collection laws. So that bucket may be quite large at the end, knowing that we're not going to get it, but that's the interest bucket. So principal is repaid along the way. If the borrower hits all the benchmarks along the way, then we get the next, typically we would get 120%, even though we're still getting split pari as an interest catch up.
And I want to make sure that term split pari, just for those of us on the call who may not be familiar with it, what does that mean?
Sorry, pari passu. So when the remits come in,
yeah,
$100 comes in, 90% of it goes to me, 10% of it goes to them on a 90% advance rate.
Got it.
And after then our 120 hurdle is met, somewhere after the 28-month mark, then we go to a 50-50. And again, our 50 then gets categorized as interest because that's accrued and accumulated on the backside.
Perfect. Greg, Jeff, any modifications there?
I think our setup is very similar. We typically start off at 85. We've gone to 90, depending on the asset. We'll go as low as 60, depending on what our client needs are.
And you're talking again, that's advance rate upfront.
That's advance rates, right. My kind of recommendation is to anybody out there is, as they're evaluating their financing, is you really just have to build the model. You have to build a model out that shows how much you're going to collect on a monthly basis, how much is going to servicing fees, how much going to legal, and then how does the split work on the back end. I think that there are so many different flavors of what we can do, each of us individually or as a group, that it's very important for you as the borrower or the co-investor to understand how those proceeds are split, and then calculate kind of what your return is off of that structure. Because I have so many different levers that I can pull, whether it's advance rate, whether it's pari passu or senior junior, whether I'm taking 50% of the back end or 25% of the back end. It just, all of this stuff is dependent on the portfolio and the yield of the portfolio and our confidence that that our counterparty can execute on the actual collections of that portfolio.
Yeah, well said.
What I would say is, especially the groups that don't have as much experience, if you're collecting low balance $500 consumer loan obligations, and you come and say you want to collect $20,000 balances now that you want to buy, I would say that you probably should think about, if you haven't had a roster of purchasing, that you have a history of collecting a certain type of consumer vertical by balance, geography, all the things that would prove out that you could handle your performance of collecting that specific obligation. So I'd say, the less experienced buyers, I think everybody could get comfortable in a different way with you if you have experience collecting that specific type of obligation.
Certainly helps. Yeah, yeah.
Chris, we have a couple of questions. If you want to you might be able to read.
Yeah, I did. In fact, Jeff, I'll ask you to go first on this one. One of our attendees has asked if court costs are typically advanced or is it only portfolio costs? So this is a legal focused debt buyer.
Yeah, I mean, you can, it's typically the first thing taken out of the waterfall. So, you know, we can finance court costs or not, depending on, you know, who the law firm is and what they prefer.
Perfect. Greg, Todd?
We build it into the waterfall the same.
Okay.
And if we're working on a legal heavy portfolio, there may be the time where we're actually funding the court costs. It just depends on how the ultimate return of the portfolio ends up. So we build it in. We can absolutely build it in.
How
Same.
about you, Todd?
Yeah,
Same.
we do
Yeah.
the same thing.
Okay. Another question that came in, it's a 30,000-foot question. Our person asks, what does the panel estimate the total market size to be for the small to mid-level debt buyer group in 2025? Anyone want to take a stab at that?
I think Greg will take a stab at that one.
Yeah. So I actually track all of the debt buyers in the country, about 380 of them that I'm tracking.
Wow.
And I've assigned a value to each one of them. We think that the total universe in 2025 is going to be over $3 billion. Now,
When you say 3
understand
billion, Greg, do you mean everybody
Spend.
gets to learn on the call?
in spend,
Do you mean 3 billion in spend?
in spend.
Wow.
Is that right?
Now, if you look at it, you can pull down the financials for Encore, for PRA, and then you can throw in Resurgence, Jefferson Capital, Velocity. They're going to eat up about 60% of that.
You know,
Okay,
yeah,
about 60% of that number, because they're. I think, you know, PRA and Encore are doing over $1 billion in spend a year as it is. They're doing like $1 billion. I want to say one did 700 million, the other did 600 something.
that's what I'm under the understanding of.
Right. So then
This is over and above that, though. This is when you're saying that, you're saying in the small to mid-sized debt buyers that you're tracking that are lower middle market or lower middle market, that the combination of those buyers will be a $3 billion spend.
No.
No?
I'm saying the entire market is about 3 billion.
Okay.
Now you back out the big boys, right? And some of those and some of the larger buyers, you know, you're probably about $1 billion, 900 million spend a year in the lower middle market.
Yeah, that's impressive. Steve, hopefully that answers your question. Thank you, Greg.
Thank you,
And
Greg.
well, we think it's going to increase. We think it's going to increase with volumes. We haven't adjusted for the new volumes, but
For sure. All right, I want to, time's going fast. We're at 46 minutes here. We got about 15 minutes to go.
One more question.
Oh, is there one more? I'm sorry. Go ahead, Murph. I don't see it. on my
Yeah,
side.
quick question is the interest rate a fixed rate over the life of the loan? Typically?
For us, no. In Ironwood's case, no. It's there is no fixed rate.
There you go. Keep going, Chris.
Okay, so now I want to talk about the steps in identifying your ideal lending partner. And Jeff, Greg, and Todd, I'd ask you to jump in here, but I've listed a few ideas in terms of things if a buyer's looking to explore a relationship with a lender. I often think one of the best steps is to share some information on a prospective opportunity. But let's talk a little bit about how you get to know someone, your due diligence process. So let's say after today's call, someone's interested in exploring a relationship with you. What are the first steps that they should take? Jeff, I'll ask you to go first.
Who'd you ask to go first?
I'm asking you.
Okay. I think, as you just mentioned, I think you have them call, you set up a conference call, and on that conference call, you ask them a pool of questions so you can get a feel of them as people and their operation, as their experience, how they look at the world, their opportunity set. And then, as you've illustrated here, we give them what we call a short form due diligence script so that quickly they can feed us information so we can get a feel of what their experience set has been and their ability to report. And I can't emphasize that enough, that most importantly is, can the potential borrower report accurately and timely? And so that I would say, they get their script done, then you can have a real conversation about whether we're potentially a good partner for them. Phone call, try to know them as people, and sort of corporately, their experience, their history, and then a short form due diligence script that they can fill out so you can see if they have what one would consider enough expertise or history or experience to
Perfect.
be a successful borrower.
How about you, Greg? Same?
Yeah, it's very similar, right? We have a due diligence list. We're looking for financials, we're looking for licensing, we're looking for platform information, process and procedures. I think that's all very important. Some of our newer debt buyers don't have all that built out. So we'll find out, we'll create some proxies. But I think the most important thing that we look for, and it's a hard thing to measure, it's integrity. And so, and what I'm talking about there is, if a lender, if we know borrowers at times or partners get into trouble and things don't go as planned, we have a lot of respect for the folks that come right out, tell us what the problem is, tell us where they're having issues, and we can help find a solution to fix it.
Yeah.
We really have, we've had some folks that hide those problems from us. And what happens is it becomes a much bigger problem. And so integrity, reputation, and general honesty is big. And so we do that by, we do reference checks, we do background checks. We look at your experience, maybe you're with a new debt buyer or you're starting a debt buyer, but you were somewhere else for 10 years. We take that into account. But, there's always a solution for us. We understand this is a risk game. We're not going to win on every one of our investments.
Yeah.
We just want a partner who's going to be upfront and be very clear with us, as to what the status of the investment is and their platform.
Amen.
Follow-up question, Todd, before I turn it over to you. Is it best, Greg, do you want to see does it help if someone brings an actual opportunity, or is it best to engage before there's even anything on the table?
Okay, that's a great question. And my answer is, and Jeff's and Todd's may be different, we can onboard somebody relatively quickly. I prefer, so that you're not wasting your time, we're not wasting our time, is bring an opportunity to us. We'll take a look and see how you underwrote that opportunity. We'll underwrite it. We'll put a structure together. And at that point in time, we're going to learn a lot about each other through that process.
Yeah.
Whether you have experience and how you underwrite, how you view a transaction. And then I'm going to present terms to you. And if those terms work, and we decide that, hey, this is going in the right direction, we can quickly do the due diligence process. The stuff we ask for are stuff that you probably have supplied to your sellers, or you've supplied to agencies or to people you're doing contingency work for. It's a standard package. So that should be a relatively easy process.
Okay. Todd, I want to give you a chance to chime in.
Very, very similar. Due diligence, checklist, background checks, all of those things, financials, everything that was mentioned. And just to answer the last question, you threw out, we would actually prefer to start that process prior to an opportunity coming to the table in our case.
Yeah, yep. No, that's great. I think that's good for people to hear too, because what we have as a broker, what I often see happen is someone wants to buy a portfolio and they're scrambling to find the financing and there isn't, sufficient time because when they're busy, you guys are usually busy too, right? And so you want to make sure you leave enough time to
I would
to
agree
get
with
the
that.
process. Yeah, yeah, good stuff. Okay, couple more.
Chris, I had a question.
Yeah, please.
So again, the novice, and I know this based on recent RMAI conversations that took place. So as in the old days, I borrowed money. The biggest concern was, all right, I have my plan, I built my model and all that. I'm borrowing money. How active is this lender going to be up in my kitchen? Or are they hands off? Do they just say, hey, here you go, just give me monthly reports? I think that's one of the things in today's market, I don't know how that goes. So I may not have said that in the most eloquent way, but I think
Well,
get-
you mentioned, so I think, Jeff, you mentioned the ability to report is essential. Murph, you just mentioned monthly reporting. What is the sort of expected standard now? Is it daily reporting, weekly reporting, monthly reporting? Is there a standard?
Are you asking me?
Yeah, I'm asking you.
All right. What we do with every borrower that we have, we create a custom remittance report. We do two things. We have a custom submission report that certain information needs to be on that submission when they're trying to purchase an opportunity. And then every month, we have a monthly remittance report that tracks all the metrics that we want tracked. And then we roll it into an asset oversight file that tracks the historic cumulative metrics. But I would say, depending on, the counterparty, you remit once a month, but you have more contact. You could have more contact than that based on multiple purchases through the month or different things that could come up from court costs or, whatever it is, you want to have connectivity. Then quarterly, we do what we call a forensic review, where we check the bank accounts and the cash disbursements to make sure that everything is, staying on track and is being reported. It really, if somebody can report, that's such an important thing.
Yeah. And does that, in your experience, Jeff, does that come down to the system of record? Is it system based? Or are there other factors there?
Well, if you're checking accruals versus cash, you're going into their bank account.
Yeah.
And making sure that if they say these payments are being made, we're making sure that they're hitting the bank account to make sure that everything is, we're on top of all the disclosure and transparency that you need. Other than that, we're not in their grill every day. They got to run their business.
Yeah.
That's why we customize the submission form and the remittance report. And then from there, depending on the activity of the borrower, you have, some intermonthly communication, but not a lot. It's sort of dynamic.
Yeah, understood. Greg, same for you, I'm guessing.
The cadence is really dictated by our client. We require a 1 monthly, payment stream, and then we have a performance call, which is usually a half hour once a month to review the performance and the remit. I have clients that I talk to almost every day because we're evaluating and strategizing over new deals and underwriting, and I have other clients that I talk to once a month.
Yep. How about you, Todd?
We have from the beginning reconciled to probably the state of overkill. We take the original media file, upload that into our system, and then on a monthly basis, we get the monthly remit all the way down to the debtor level and reconcile to the original file. We keep a running total of everything in terms of what's left in the portfolio, who gets moved to cease and desist, BKs, all that gets scrubbed out on a monthly basis. I'd say we generally talk to our borrowing partners weekly, but it's not necessarily set. It's just sort of what happens. You're just talking about normal business for one reason or another. Sometimes it's more, sometimes there's not much to say, and it might be just a quick call with a quick question. But we've then also taken all of our data over the years, and that's what was used to build out our stratification program. So we've really tried to data mine on the back end with performance results from past portfolios. So it's been important for us all along the way to continue to try to utilize the data that we've had over 20 years for some good as it pertains to pricing, at least going forward.
Yeah, that's awesome. That's
Real
awesome.
quick before you go, for the attendees that are there, anybody who would like to be contacted directly by one of these panelists, if you throw that into the questions, answers, and just put in there who you want to be contacted by, we will capture that data and connect you to post webinar. So while you're there listening to these answers, either on the chat or on the question and answer, just put in who you'd like to talk to after the webinar, and we'll pass that along.
Yep. Thank you, Chris. Thank you, Chris. All right. You know, it's amazing how quickly the time goes. We're up at 60 minutes. It will give up 30 more seconds for anyone to submit any additional questions. Obviously, we can connect you with any of these gentlemen following the phone call if you'd like. Just a quick plug for selflessly for DebtLink, where we're going to be. I want to remind everyone that the panelists today are all premier members of DebtLink in the specialty finance category. If you have interest in participating in or sponsoring a webinar going forward, please don't hesitate to reach out to either Chris or to me directly. Again, Jeff, Greg, Todd, great conversation. Thank you all for joining us today. We will be sending a copy of this presentation deck and a recording, if I didn't screw anything up, of the webinar to everybody within the next 24 to 48 hours. Guys, any parting words for our attendees? Jeff?
Thank you for
Thanks for your
inviting
time.
us
Appreciate
to be able to talk about these topics with with a great panel.
This was a great discussion, everybody. Thank you. And again, final thanks to our gracious sponsor, LexisNexis Risk Solutions.
You did that good, Chris.
I appreciate it.
Great.
I'm working on it.
Great job.
Thanks, Chris.
Hey, go to deblink.com. It's free. It's a great resource to find sources. These three guys specifically, the sponsor, if you're looking for help with skip tracing, asset search, things like that, especially lenders. It's a private, so if you go there and you're looking at it, nobody's capturing your information. So it's a resource. So hope to see you there as well.
Thank you, Murph.
Thank you, everybody. Have a great day.
Thank you.
Thank
Bye,
you.
guys.
All right. I have